defining what financial instruments are. So the topic of tonight's session, as well as on Thursday's continuation, is all about financial instruments. But we have to define it. We have to have a unified or a common definition of financial instruments. Now, according to the accounting standards, a financial instrument is actually a contract. So there are two counterparties. You cannot have a contract with only one party. No, that would be very sad. But a contract it has at least two parties, wherein one party to the transaction obtains a financial asset, while the other party or the counterparty generates either a financial liability or an equity instrument. So it's a contract where one side obtains a financial asset, the other side generates or obtains either a financial liability or an equity instrument. In certain cases, it could be a combination. So in any case, for those accounting professionals out there, one side leads to a debit, the other side leads to a credit. And that's pretty much how accounting works, no? Because of the double entry system or concept. Financial instruments are contracts, so they have terms, provisions that embody what those parties will what are the rights and obligations of those parties that have entered into, wherein one party would have certain rights, probably the holder of the financial asset. The other side would have obligations or would have to comply when the counterparty exercises those rights. So, yan yung basic elements or definition of a financial instrument. An asset is any resource controlled by the company. A liability is obligation of the company. Equity is the residual interest in net assets of the business. And later, we'll discuss on the difference between the difference between financial and non-financial. So, in a nutshell, a financial instrument or a financial item in the context of accounting and financial reporting is anything that is cash or close to cash. We'll have an example later. Non-financial items pertains to properties that are in its nature are in some other tangible form, be it real property such as land or building. It could be equipment, machineries, furniture. It could also be in an intangible asset such as copyright, trademarks, or patents. However, those items, those assets, don't necessarily convert easily into cash. Hence, they are non-financial in nature. Financial items are quicker to be converted into cash. So ito yung the term liquid. Those items that are liquid could be converted into cash by incurring little or very minimal transaction costs. Whereas for non-financial items, these are items that may be converted into cash, but either it will take a considerable length of time or may incur the company higher than acceptable transaction costs and losses. The values of financial items are a lot more volatile, given that they're closer to cash, versus a non-financial item, which is used in the business for generating cash, but are not necessarily representations of cash themselves. A land or a building could be leased out and could generate recurring cash inflows via rental. However, the value of those properties may or may not necessarily attach to its ability to generate those recurring cash flows from rental activities, versus a financial instrument such as, let's say, a corporate bond. That corporate bond, the value of the structure of the cash flows of the coupon payments and principal basically drive the value of that instrument. So between the two items, non-financial and financial, financial items tend to have more volatile value as a nature, or by its very nature or attribute. Examples of financial instrument is cash. Cash is legal tender, no? The coins and bills that the government issued. In reality, the cash or legal tender backed by the government is actually an obligation by the government. Meaning the 100 peso bill that you hold is obligation of the government to the extent of 100 pesos. What does that mean? When you use that 100 peso to buy a product worth 100 peso, the government is essentially saying we have an obligation to protect the value of that bill, and that you can force anyone to accept it as a mode of exchange, because we have the obligation to convert that into 100 pesos worth of currency. So it's a financial instrument per se, but cash is the purest form of financial instrument that a business would be pursuing in relation to the conduct of its business, because cash can be used to generate either more cash or assets, which in turn could help the company build or generate revenue, which will in turn become more cash in the future. Another type of financial instrument would be a right to receive or an obligation to pay cash. So that particular structure, provision of a holder having the right to receive or an issuer having the obligation to pay, those features create rights against cash. Now, either rights to receive cash or rights to deliver cash. In any case, those features are another form of financial instrument. And as mentioned, a financial instrument could be equity instruments, which are residual interest in net assets. What do we mean by residual interest? These are claims against the business, against its assets, after deducting all of its liabilities. And it assumes that the business will be in a liquidating concern rather than going concern. And that equity instrument, if you're able to generate value from assets well over whatever liabilities it may have, all those leftover, called net assets, become ownership of the equity holders. Hence the term residual interest in net assets. So financial instruments are contracts that create financial assets from one side and a financial liability or equity, or in certain cases, a combination on the other side. It could be cash, a right to receive or an obligation to pay cash, or a claim on residual interest in net assets of the business. We'll dive into these examples in a short while. Okay. Let's quickly look into the balance sheet. The balance sheet is a statement, an accounting statement that provides a snapshot of where a business is as of a given moment. You understand, most of you are accounting and finance professionals, and are already pretty familiar with what the balance sheet is. However, it's worth revisiting this concept so that we'll have a refreshed understanding of these concepts. Okay. A balance sheet is shows what are the company's resources, obligations, and equity portion as at a given date, as a given point in time. On the left-hand side of your balance sheet are your assets, which are your economic resources that essentially the business controls and are used to generate value over time. So it could be inventory that the company can resell, or equipment or machinery that helps the company produce assets, or other types of equipment that help it provide the promised services to its customers. On the right-hand side, you have your obligations or debt or liabilities. These are obligations by the company, meaning there's a commitment or promise by the company to deliver or settle via payments of future cash flows. As mentioned, equity is the residual interest in net assets. Basically, within the business, it is the owner's interest. Debt or liability are actually the creditor's interest in the business. So the balance sheet, when you look at the balance sheet, the left-hand side provides you with the outstanding economic resources used by the business to generate value and in turn revenue, while the right-hand side, the combination of debt and equity, provides you with the claims and interests brought in by either creditors or owners in the context of the business. Another way of looking at the balance sheet is that your right-hand side, your combination of debt and equity, are actually your sources of funds. Looking at it from the perspective of management, your debt and equity sections of the balance sheet are your sources of funding. So when you're asked, is the business growing? You don't look at the asset side of the balance sheet. You look at the liability and equity side of the balance sheet. Why? Because sources of funding connotes that these are the pool, the amount of funds that you can leverage and use to grow the business. And if that pool is growing, then the business likewise is also growing. And analyzing sources of funding would tell you where is the growth coming from. Is the growth coming from accumulated profits over how many years? So this is the term that you would hear, organic growth. Is the business organically growing, meaning on its own by keeping its profits and reinvesting those profits over a long period of time? Or is the business growing because it's borrowing continuously? So looking at the debt side, if the debt to equity ratio, for example, is more than 1, meaning the company leverages more debt than equity, then the company is essentially absorbing more financial leverage in fueling its growth. So when you are asked, is the business growing? You look at the sources of funds. You look at the right-hand side on the combination of debt and equity. Analyze that side, and then you can explain, yes, the company is growing because it's been earning profits for how many years and it's reinvesting, or it's growing because it's able to raise funds through borrowing. On the left-hand side are your uses of funds. Now, when you raise when you start a business, you raise funding by either issuing debt or getting funds from the owners. When you're asked how efficient is the company's management in using or maximizing the resources it was given to, you look at the left-hand side of the balance sheet, uses of funds. So you analyze, or the company has 100 million pesos worth of funding, a combination of 50 million debt and 50 million equity, and the management deployed that 100 million, let's say 70 million to equipment, 20 million on working capital, and 10 million in idle cash. So when you're asked how efficient is the company when it comes to using its raised funds, you look at the left-hand side. When you're asked how is the company growing, look at the right-hand side, sources of funds. And when we talk about financial instruments, it's important to understand which perspective are we coming from. Are we talking about financial instruments as a source of funding by the company, by the reporting entity, or are we talking about financial instruments as a deployment or usage of funds as assets that they generate value out of? We talked about the balance sheet. So again, the balance sheet tells us the standing of the company as of a given point in time. Now, the next financial statement that we're going to talk about this time around would be on the income statement or statement of operation or statement of performance in certain instance. Now, the income statement basically tells you where did all the value generated by the business for a specific period of time. Kanina, the balance sheet talks about at a given point or a snapshot as of this date. Where are we right now? The income statement provides you with a visual, a report on what has transpired over a period of time. Let's just say 1 year or 1 quarter or 1 month. The income statement tells you where are all the revenues and gains come from. If the business is into merchandising, all the revenues that have generated through the sale of those merchandises, as well as all other sources of income. We also see in the income statement all the expenses incurred by the company. For example, in a merchandising business, the cost of sale is also an expense. Likewise, all other losses and charges are presented in the income statement. Now, looking at this, there is a differential. No? Basically, the goal of any business is to generate as much revenue by incurring as little expense as possible. So maximize revenue, minimize expense. That's one of the common ways for businesses to sustain itself. And the difference of those two is actually the company's net income. Now, the goal is to maximize the portion, to maximize the net profits that a business could generate arising from its operation of generating a lot of value through revenues and gains by minimizing its incurred expenses and losses. Now, the third financial statement that we need to talk about would be cash flow statement. Now, the balance sheet, as mentioned, that's a point in time. The income statement is as of a given period. So basically, you can create a statement of cash flows by plotting two balance sheets at separate points in time and then bridging them through the income statement. So basically, your cash flow statement shows you the movement of cash, increase or decrease on a period-to-period basis. So cash at balance at the end of the current period compared to the cash balance of the previous period. And change in cash can be split between cash from operations, cash used in capital investments, and cash from financing. Cash from operations, basically, as the name suggests, it comes from earnings before taxes, depreciation, and amortization, plus the changes in non-cash current assets. And it also involves changes in current liabilities. So, long story short, the cash from operations, as the name suggests, are all the cash inflows, net of cash outflows it has generated over a period of time arising from the conduct of its business. Cash used in capital investments this time around are mainly coming from changes between your non-current assets, which are mostly long-term in nature and would require you to invest in that business. It also is adjusted or calibrated against depreciation and amortization because it is a non-cash expense that impacts the net income but doesn't necessarily impact the cash movement within a particular year. Rather, that particular cash impact has already been captured when the cash used in capital investments was earlier computed at the time of the capital investment. Finally, cash from financing, as the name suggests, came from non-current non-current liabilities rather, basically providing us with sources of funds arising from raised debt funding, or in certain cases, even changes in paid up capital during the year. So that's your balance sheet, income statement, and cash flow statement. So there are two other parts of the financial statements. You have the changes in equity and notes to financial statements. We'll discuss those items further in the next session. Okay, so we'll focus on, for now, we'll focus on the balance sheet. And with the balance sheet, so we have your assets, liabilities, and equity, or debt and equity. And for purposes of financial instruments, we have to understand which perspective are we coming from. Are we looking at the issuer's perspective? In this case, we're looking at financial instruments as sources of funding. A company could either issue debt or issue common shares of stock as a form of raising funds to be used in the business. On the other side, from investors' perspective, we now have to look into it as the usage of funds, as a deployment of those funds to generate a revenue or value down the line. Could be to collect interest accumulated over time, or even use the financial asset as a container for future value that could be sold off at higher than its acquisition price. Now, it's important that we, in terms of financial reporting and accounting of financial instruments, we have to understand which perspective are we coming from, be it the investor perspective or the issuer perspective. In either case, the definitions would remain the same, but we have to look into it mostly from the issuer of the company as the issuer of those financial instruments. Let's begin by defining what is a debt financial instrument. A debt financial instrument is a contract wherein the company issuing the debt commits to pay cash, or if a company that is holding that instrument to receive cash, they have the right to receive cash, or another financial instrument, which eventually will become cash, either at a fixed or determinable amount of cash flows in the future. This is important, that the term fixed and determinable, because this provision segregates and differentiates debt instruments from equity instruments. We will highlight later. Okay? Remember that a company issuing debt is actually providing the holder the right to receive cash, and the company having the obligation to pay cash. And for it to be considered a debt instrument, that commitment must have either a fixed or determinable amount of cash flows in the future. The debt instrument is an evidence of the borrower's promise to repay cash flows, usually comprised of principal and interest to the lender or holder of the financial instrument. So earlier, fixed or determinable amount of cash flows, that instrument is actually evidence that the holder can use to invoke its right to receive said committed cash flows, which comprise usually principal or capital amount and compensation in the form of interest. The holders of debt financial instruments are exposed to credit risk. And in later section on expected credit risk, we will discuss what credit risk actually is. On the flip side, from the issuer's point of view, debt financial instruments exposes issuers on market and liquidity risk, particularly funding liquidity risk. So funding liquidity risk is the issuer's risk of not being able to timely and or completely settle their debt financial instruments as they come due. That risk is the flip side of that risk is credit risk, this time from the holder of the debt financial instruments point of view. Examples of debt instruments are payables and accruals that we see being incurred by the company. Essentially, payables are usually related to the trade or the business, and they are commitments by the company to settle in cash. This is fixed based on the invoice amount at a point in time. The opposite of payables in the other counterparties books is your receivables. Another type, as mentioned, would be accruals. Accruals are financial instruments per se, in the sense that when you accrue a liability, you're basically recognizing on record that the company is bound to deliver cash at some point, like equivalent to this amount. This usually pertains to expenses already incurred, but not yet settled as of cut-off financial reporting date. Compensation, payables to suppliers, etc. Bank loans are your other types of financial instruments, debt financial instruments rather. Now, as the name suggests, these are issued by the banks for the benefit of the borrower company. They get to raise funds and get to repay them based on the bank's agreed upon terms and conditions. Bank loans are actually designed by the creditor banks in terms of the product features. Corporate bonds and notes, on the other hand, are more designed by the issuer themselves. So if a bank can say, okay, the bank loan is for 3 years only at the interest rate of 10%. The company, based on their stature or standing in the business, they can issue a longer tenor borrowing, let's say a corporate bond, instead of 3 years, 10 years. And they can ask for a higher amount. Instead of just, let's say, 10 million, they can ask for 100 million. And command a different basis for interest rate, depending on market conditions, the standing and creditworthiness of the company, and the capabilities of its investment advisors and underwriters. Corporate bonds and notes are financial instruments that are debt in nature from the issuer's point of view. It's also a debt instrument from the holder's point of view, in that the holder is exposed to the issuer's commitment to repay the cash flows embodied in the provisions of the corporate bonds and notes. That's debt financial instrument. Equity financial instruments are any contract that evidences residual interest on assets of an entity after deducting all of its liabilities. That's why the graphic here is a fishbone. Kasi tira-tira na lang po ang matitira sa equity holders. Whatever is left after deducting all their liabilities. Now, the business is earning profitably for how many years, then that would be a sizable amount. However, if the business is flailing and is relying mainly on creditor funding to sustain itself, then most likely this amount will not be very high. Compared to a debt financial instrument, an equity instrument, the contractual provisions, there is no contractual claim to fixed payments. There's no promise of repayment of any principal. In a debt instrument, when the lender gives money to the debtor, that debtor is obligated to return the principal amount given by the lender plus compensation in the form of interest. Equity instruments, on the other hand, they don't contain any such provision, only that it has bestowed, the issuer has bestowed certain corporate rights to the holder of the equity instrument, such as the right to vote on major corporate decisions and the right to receive dividends at some point in the future if declared, among other rights. The holder of equity investments and financial instruments are exposed to equity price risk. Equity price risk is different from credit risk. Credit risk is focused on the fixed and determinable payment of specific cash flows. Equity price risk is focused on the variability of potential future cash flows that can be generated out of the rights contained in the equity instruments. That's why that's an important distinction. Yung debt instrument, pinautang ka, kailangan mo ibalik yung inutang mo. Equity instrument, binigyan ka ng kapital, ang obligasyon mo lang, pakitain yan. Ngayon, kung hindi ka kumita, wala kang obligasyon ibalik yung pera. Kasi walang karapatan yung may hawak ng equity instruments to demand any payment because there was never a promise at the beginning. Kung may promise na ganun, hindi siya equity instrument, debt instrument siya, which defeats the legal form of the instrument. Examples of equity instruments include common or preferred shares. You have retained earnings. No, they are not specifically an instrument, but they are equity in nature, in that any accumulated and undistributed profits by the business become ownership interest and can be used to refinance the business or be declared as dividends in the future. Finally, you have other comprehensive income. This is an account that encompasses all other items that doesn't necessarily impact operation, but are nonetheless attributable to ownership interest. And later we'll have a discussion on that one. The next type of financial instrument would be derivatives. Now, derivatives could be an asset
or a liability, or in certain cases, it could also be an equity instrument. That's why derivatives is another category of financial instrument altogether. A derivative is a contract wherein its value and payoff fluctuates in response to a change in a specified market underlying. So the contract's value depends on where a particular market underlying, which is defined in the contract, where they end up by the time the contract matures. An example would be interest rates, foreign exchange conversion rates, equity prices, and even commodity prices. And currently, there are also derivative contracts built on digital or cryptocurrency assets. Another important element of the definition of a derivative is that it does not require any substantial initial investment. So it requires little or no or comparatively little net initial investment relative to its payoff. How do we imagine that? Imagine if you want to be exposed to the upside of San Miguel shares, and currently it's trading at 100 peso per share. You can buy 1,000 shares at 100 peso per share by cashing out 100,000 pesos in exchange for 1,000 San Miguel shares. And if the value goes up from 100 to 110, you can sell all those shares and generate 10,000 pesos worth of gain. That's your traditional approach. A derivative, let's just say an option. You can buy an option contract to buy San Miguel shares in the future. So let's just say you're able to get a contract. Assuming, ignore mo na natin yung very little premium. And then the contract rate is 100 pesos for 1,000 shares. If the value of the San Miguel shares go up from 100 to 110, and you exercise that option of buying it at 100 and then flipping the shares instantly by selling them in the open market for 110, then you would have generated 10,000 pesos gain. But you didn't have to cash out 100,000 at the beginning. Compared to the earlier example, I have to buy those 1,000 shares, hope and pray that the shares go up from 100 to 110 before selling them. An option contract, which is a derivative, basically, wala ako halos nilabas na cash out. Hindi ako naglabas ng 100,000 sa simula. Pero, because of the terms of the contract, wherein I am given the right to buy 1,000 San Miguel shares at 100 pesos, when the shares of stock reached 110, I could have easily exercised the shares. I could theoretically have cashed out 100,000, but then I could immediately recover that amount by selling it from the market. Yun yung second element of a derivative. The third is it's going to be settled at some point in the future. If it's going to be settled now, it's not a derivative contract. It is a spot contract on the spot. But a derivative is a contract that will be settled at a given point in the future. So a derivative, the value changes based on an underlying. It requires no or comparatively little net initial investment relative to the potential upside or downside of that contract, and they will be settled some point in the future. Now, derivatives, there are a lot of different examples of derivatives. You have forward contracts. In our example, suppose that the company has a PH-based business, meaning their main currency used is Philippine peso. The cost of running the business is incurred in Philippine pesos, but they have dollar revenues. So they're exposed to foreign exchange risk, meaning if the value of dollar to peso exchange rate goes down, their revenue equivalent in peso would also go down. Hence, they're looking for a hedging solution. In this particular case, a counterparty, in our example, a bank, they can agree today when the spot rate of dollar peso is at 54 pesos to a dollar, that the bank will buy the company's dollars. Basically, the company will sell their dollars, the asset, at the contract rate or contracted rate in advance. So, today, 54 pesos. Sige, bibiliin ko yung dollar mo, sabi ng bangko, at 56 pesos. To be delivered in the future. Kasi, yung company na may dollar revenue siya, pero hindi pa niya nakokolekta right now. Pag makolekta niya, kinakabahan siya, baka mamaya, yung 54 pesos to a dollar, 51 na lang by the time makolekta niya. Hence, kaya siya pumasok in a forward contract to agree and fix the collection rate in the future. That's a forward derivative contract. A swap derivative contract follows the same function, pero instead of one time, series of cash flow siya. So in this case, the company borrowed at a variable interest rate, meaning pabago-bago yung interest rate depending on the prevailing interest rate at the time of repricing. And they are foreseeing interest rates to be increasing because of inflation. If inflation is increasing, expect that interest rates would likewise increase. If inflation is stable or decreasing, expect as well that interest rates in the market would likewise be decreasing. They have a positively correlated relationship. Now, in this particular case, the company can approach a bank. Okay, let's agree today kung a 3-month rate mo 4.5%, that in the future, let's fix that interest rate. Gawin nating 5%. So, yung utang mo dati na floating, because of the swap derivative contract, it now becomes fixed in substance. So, yan yung swap contract. Kanina, forward contract, one time lang. Derivative, ang swap derivative contracts naman, over a recurring period of time. An option is, as the name suggests, it's an option. It's a right, but not an obligation to be used. If a company is not sure if they need to buy shares of stock in a month, then the bank can agree that, okay, I'll give you an option in exchange for a small premium. You have the right, but not the obligation, to buy the asset from the bank at the strike price or contracted price to be delivered at some point in the future. So kanina, example natin sa San Miguel shares, the bank provides the option holder the right but not the obligation to buy San Miguel shares at 110 if they pay the premium now. So para siyang insurance contract. In an insurance contract, you pay premium, and then the insurance company will pay you a set amount depending on the coverage, depending on the risk being insured, if and when an insurable event occurs. Ganon din sa derivatives. But as we will discuss later on, magkaiba sila, and we will highlight that later. Sa insurance, usually from a buyer's perspective, policyholder perspective, prepayment siya of services that will be rendered over a coverage period. Pero for the insurance company, it's actually a coverage commitment, a type of liability. It's a financial liability, but the nature is very different, and hence it will not be covered by IFRS 9. Insurance coverage could be over property, over health, or life. And property, hindi naman lahat ng may kotse knock on wood, magkakaroon ng car damage out of accidents. But some will be exposed to that as a result. It's in the very nature of ownership of vehicles. Health, some of us may be afflicted by an illness which require us to cash out more than what we have in the bank, and hence a health insurance coverage becomes quite useful. And also, no, I don't have to highlight it, but life is finite, and everyone will reach a certain point where we have to go. And going also could be either be farther away in the future, knock on wood, it could happen anytime, and that could also have economic effect. So the economic effect could range depending on the value of the property, the amount of healthcare costs, or even the economic revenues forgone if a life is taken out. Now, we also have to talk about a few accounting concepts. One is substance over form, which basically says that we look at the economic terms in substance rather than its legal form in concluding on how to account for the financial instrument. You also have to think about matching and accrual. Basically, rather than looking at the timing of cash flows, we look at the timing of the economic effect. If a revenue has been delivered but has not been collected, that particular expectation of payment must be captured as at reporting date. Finally, when we elect an accounting policy, such policy must be implemented consistently. In the financial statements, it's being prepared by the management, and embodied in those reports are management assertions. Basically, these are the underlying messages being communicated by management when they prepare financial statements. Existence or occurrence is management assertion that a particular asset thus exists and they can be verified by vouching. Or a particular transaction actually occurred, such as sale of goods. Completeness is the assertion by management that all the items that you see in the financial statements are all the accounts relevant to that account title. For example, if you see this amount of accounts payable, these are all of the company's relevant accounts payable. Similarly, in the income statement, completeness likewise state that whatever number or item that you see is actually complete. Everything that you need to see, you can trace it back to the supporting documents. The third assertion will be on valuation and measurement, wherein management asserts that the number that you're seeing there is reasonable and appropriate, that the amount presented in the income statement was measured reasonably and appropriately. The fourth assertion is on rights and obligations. So basically, the management asserts that whatever assets that you're seeing in the financial statement, management has legal right over it, legal defensible rights and title over those assets, and that the obligations that you see there are valid obligations, either trade obligations or financial obligations by the company. The last assertion is on presentation and disclosure, wherein management asserts that all the information that you see here meets the minimum requirements by the accounting and financial reporting standards, and that all other required information may be found in the accompanying financial notes to financial statements. Now, why are we talking about the assertions? So this is a masterclass on IFRS, and IFRS is relevant on the financial statements being prepared. And those financial statements, as mentioned, contain the implied messages by management called management assertions. And each of the accounting standards that are relevant for financial instruments also aligns to particular assertions that we need to bear in mind when reviewing those financial statements. IFRS 9 is the primary financial reporting standards for financial instruments. And later we will discuss the background on those financial instruments, on those provisions. But tatlo yan: classification and measurement, expected credit loss impairment, and hedge accounting. And the first section, classification and measurement, touches upon all of the 5 management assertions contained in the financial statement. Your expected credit loss impairment provision mainly focuses on valuation and measurement, particularly on credit assets, communicating to the financial statement user that the values of those credit assets are reasonable and adjusted to factor in for bad debts. And that all the numbers that you see when it comes to credit loss impairment, it has captured everything that is relevant. That's why valuation and measurement and completeness assertions are impacted by that section of IFRS 9. For hedge accounting, it also impacts valuation and measurement, but also presentation and disclosure, because hedge accounting is actually an exception to the classification and measurement provision of IFRS 9, which we will discuss in detail in the next session. Another accounting standard that's relevant to financial instruments is IFRS 13, or the Fair Value Measurement Standard. It contains the relevant provisions on financial instrument valuation and how those value figures should be presented and disclosed in the financial statement. Another accounting standard is IFRS 7, which is the financial instrument disclosures. So as the name suggests, it provides detailed disclosure requirements on a variety of financial instruments and cases. I've also included here IFRS 17, which is on insurance contracts. Now later, I have to qualify that insurance contracts are not financial instruments per se. However, it also we also have to touch upon it, because eventually financial instruments, insofar as the financial markets industries are concerned, insurance is a critical part. And I think it's worthwhile that we touch upon that topic as well. And all of the management assertions are impacted by that accounting standard.